Hello everyone, and welcome to another episode of the Daily Gwei Refuel, where I recap the latest news in the Ethereum ecosystem. I'm your host, Anthony Sassano, and today is the 8th of February 2021. Alright everyone, let's get into the news from over the weekend. So actually, before we jump into the news, I did want to go on a little bit of a rant because I got into a lot of heated, discussions over the weekend on Twitter about, different Ethereum competitors as, they're getting kind of, popular lately, I guess you could say, because of the fact that the gas fees on Ethereum are high. So, you always have people going, gas fees are going to kill Ethereum, come use this chain, it's better, it's faster, blah, blah, whatever, right? And in general, I try to be very open-minded, right, about certain things. And, when you've been in the space kind of like as long as I have and you've seen kind of like all these things come and go, it becomes very hard to be open to, like newer things that you've seen fail a million times before. Like, the quote-unquote Ethereum killers have been around for a while now, right? We had like one of the biggest ones kind of launch in 2018 called EOS, right? And back then there were so many people shilling EOS for the exact same reasons as they're kind of shilling these other things today. It's basically the same old kind of talking points of, it's more scalable than Ethereum, it can do more transactions, who's going to use this, if who's going to use Ethereum and only do 15 transactions per second, blah, 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 blah. And, it's funny because since then, Ethereum has just kept growing, right? Ethereum has not stagnated, it's developing, it's growing, it's as big as it's ever been, right? So, and EOS isn't the only one, I don't want to kind of harp on any particular project, but there's like a whole laundry list of them that were around, in the 2017, 18, kind of 19 cycle, which just got completely washed out, right? They got basically zero traction, and no one even really talks about them anymore. Like, you might hear some people talking about them here now and again, but there are literally some that were talked about so much in 2017 that I haven't heard about for years now. Basically, I didn't even hear about it during 2020. So from that perspective, right, and this is why, like, I guess a lot of us in the Ethereum ecosystem are extremely skeptical of any of the other quote-unquote Ethereum killers or competitor chains, right? There's a fair few out there right now. And of course, they're getting a lot of attention because of the high gas fees on Ethereum. And I think they often act as like a trap for newer people as well, because newer people obviously don't have very much to go off of when they get into this ecosystem, right? Their first experience of Ethereum these days is unfortunately they load it up, they see what this DeFi thing is all about, and then they're hit right with like $40-$50 fees, right from the get-go. So I can understand why people fall into this kind of space where they go onto one of these other chains, and a popular one is Binance Smart Chain, for example, and again, I don't want to single out any projects, but I just want to give some examples here. But that's a popular one that people always mention to me and say, Ethereum's going to lose to Binance Smart Chain because they have like lower fees and more transactions and blah, 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 and all this stuff. But these people never, I don't know if they question it to themselves, but they never actually seem like they question why this is the case, right? So why do these other quote-unquote blockchains have lower fees and higher transactions per second, right? And the common denominator and the answer across every single time is that they sacrifice decentralization for scale, right? So in Binance Smart Chain's case, they have 21 validators. That's it, right? Have 21 distinct validators who, they say are run by 21 different people or whatever. But in reality, I would bet that most of them are run by the same few entities. And if push came to shove, there would probably be a central party that could shut down that entire chain, right? And it really, I really is controlled by Binance. So I wouldn't even compare that to Ethereum because it's very, very different, right? To shut down Ethereum is extremely hard. Yes, miners go into mining pools, right? And then the mining pools get all this hash rate and it kind of centralizes from that perspective, but it's not the same thing because miners can switch from different pools, right? Like instantly. They're not tied to a different pool. And it's not a permission thing where you need to be one of these 21 validators to validate the network. Anyone can become a miner, right? Or in ETH2, anyone can become a validator slash staker. So there's that perspective. And that's always what happens, right? There is not a system that I know of today that scales without sacrificing decentralization. Even sharding to an extent doesn't give you the exact same kind of properties that like a kind of singular blockchain would. And this is just how it works. This is the very technical, this can be very technical, and I completely understand why newer people to the ecosystem kind of fall into these traps where the marketing from these other chains where they're like, we're more scalable, we've got low fees and all that sort of stuff. And the second thing is, thinking to yourself, well, I mean, you've got low fees because you don't have any usage, right? You go on these other chains, you look at their transactions per second, or their transactions per day, and it's usually very, very low. Like I looked at one before, and again, I don't want to single anyone out, but I looked at one before, and it was doing like, I think 10,000 transactions over 24 hours. And the thing is, all those transactions, and I looked through a lot of them, were just staking transactions and arbitrage transactions. So it was basically, these chains are obviously proof of stake chains, and it was just staking rewards being paid out. And then it was just arbitrage transactions from exchange to exchange for the token trading. There was no activity outside of that. And these networks are worth billions of dollars. So it's just, it's crazy to me that this is happening. And, I say on my tweet here that you can kind of see that it's always the same kind of talking points, like do your own research, or smart contracts coming soon, or fees are going to kill Ethereum. And I've heard all this before, and I just don't think they're good arguments. And I tried to fish for some arguments with this thread, and I got to talking with a few people about it, and I still had nothing come up, right? It was the same thing. Like, funny enough, people in this thread told me that high gas fees is what's going to kill Ethereum. And I'm just like, give me some better arguments, right? And if any of you know of anything better that for me to kind of like go over, I'm all ears. But I just have not seen any compelling arguments as to why Ethereum is going to lose its market share. Saying that the fees are going to kill it is not true, because the fees have been consistently high for the last few months, right? And the Ethereum network has kept growing. It is not stagnating. Yes, it has priced out some smaller users, but we're going to fix that with layer 2. And things like that. And the ultimate irony to me is that whenever I bring this up with people who are fans of other chains, they say layer 2's taking too long. It's not going to work. Ethereum's taking too long. It's going to lose its lead because their favorite blockchain is going to, add smart contracts soon and take over. The grand irony here is that, okay, well, you're basically saying that it's going to take longer for Ethereum to adopt layer 2, like have a bustling layer 2 ecosystem, than it would for another blockchain to basically get all the same network effects that Ethereum enjoys today. Right? Like, what do you think's harder? It's obvious what's harder. It's much, much harder for these other ecosystems to spin up and get to the same level as Ethereum. Layer 2 is much easier. So, it's just always funny when I see these kind of arguments. And, I get that there's some merits to these other kind of chains, and they have like novel technology and all that. And I'm not kind of having a go at the technology per se. I'm more having a go at the fact that, if you're building a system and you're saying that it's like an Ethereum killer, or it's like better than Ethereum, right? You have to prove that on merit. You can't just say it, right? You can't just have like a fan base who buys the token and it goes up and, they make money, so they think it's the best thing ever. You need to actually prove it. And, Ethereum is the only one that's proving that it does anything, that it does more than just like validate its own blockchain, for example. Like staking transactions or staking payouts are not, it's just staking activity. That's like nothing, right? It's nothing important. It's not like DeFi activity, right? And all this sort of stuff. So yeah, a little bit of a rant there. I don't want to go too much about this, but it's obviously a hot topic right now. And I think that if you're seeing a lot of this kind of, I guess, like on Twitter, right, on Reddit, on YouTube, you're probably seeing a lot of this. It's always good to question whatever you're sold by people. Question whatever you're sold by me. But I think that, I'm at a point where I try to be as objective as possible about this and as neutral as possible as I can be. Obviously, I have a bias against Ethereum, right? I don't need to explain that. But at the same time, there are literally people out there who will tell you all the benefits of a system without the drawbacks of it. And there's plenty of drawbacks to Ethereum. I talk about it all the time on the Refuel, right? What Ethereum needs to fix, right? Obviously, they need to fix the gas fees. I'm not saying that the high gas fees are a good thing for end users. I would never say that. But, these other things and these other chains, I always just see them kind of marketing the quote-unquote benefits. And they never, ever once say, we sacrifice decentralization to achieve scale. Because if they said that, then people would immediately clue in and be like, well, if you're not decentralized, then what the hell's the point, right? Like, literally, what is the point of a blockchain if it's not decentralized? You are literally way better off just using a centralized database because it's faster and more efficient and cheaper. And you don't have to bootstrap this entire thing, right? Which is very hard. Like, bootstrapping a blockchain is not an easy task. So from that perspective, like, it just doesn't make much sense to me. So obviously I'm going to continue to bet on Ethereum and ETH. I think that it has an enormous advantage over the other kind of chains. I think it has an enormous lead. I think that developers are what bootstrap an ecosystem and what keep it alive. And all the developers I know have zero interest in working on a kind of a chain that is not decentralized, right? They're not leaving the Web2 ecosystem that is completely centralized to just work on a centralized kind of blockchain, right? They're leaving to come into a new world and work on, decentralized open source software so they can actually stick it to these centralized companies. So that is what I'm betting on. I'm always betting on the developers, the people, the community, and Ethereum has the strongest by far. There is not even a second place, because as I've said before on the Refuel, if you were to ask 10 different people, what is second place to Ethereum, you would get 10 different answers, right? But they will all tell you that Ethereum is number one. So that to me is enough. Maybe one day we will have a number two, right? I'm not saying that these other chains can't get market share or can't kind of grow. All I'm saying is that I believe Ethereum will remain number one across like all the metrics that I track, right? It'll remain the most secure settlement layer. It'll remain kind of like the one with the most activity on it, right? The most mind share, the most developers. I just don't see any other chain kind of beating that out, because you need more than, promises of greater scalability and lower fees to attract people, right? It's such a surface level kind of argument. And if that's all you're offering, then you've already lost to Ethereum layer 2s, right? So yeah, anyway. End rant there. If you do have other thoughts, I would love to hear them in the comments, because as I said, I'm always open to learning more. I do have a lot of obviously experience with other kind of like Ethereum competitors that have been around for years. So I definitely know my way around this sort of stuff, but I'm not going to say that I like know everything, right? So I'm always willing to learn more. So yeah, if you've got things, share them in the comments or DM me on Twitter. Always happy to have a friendly debate. None of this is kind of personal, right? People like to make this religious and personal. I'm not like that. I'm not going to call you a scammer or anything just because you're a fan of another chain or whatever. That's just not a great way to go about stuff. So yeah, looking forward to some healthy debates on this, hopefully. All right, on to some more positive news, I think. So CME have launched their ETH Futures. We'll be launching the ETH Futures kind of today, or by the time you watch this, it's probably already launched. They kicked it off at 6 p.m. on Sunday, actually Eastern time, where people could place their kind of first trade. Place their trades, but the first trade would occur on Feb 8th, which is obviously today. So that's huge, right? We had this announced, I guess, a couple of months ago, where CME came out and said, yeah, okay, we're going to do ETH futures now. After, I guess 3 years, it's been 3 years since they did BTC futures. And, everyone was like, is this going to be bad for the price, right? When the futures launched for BTC, the price tanked and went into a bear market. But I think I've explained this before on the Refuel. The CME Bitcoin futures launched at the end of the Bitcoin bull market, or end of the crypto bull market in 2017. BTC had already gone 20x, right, from its last all-time high. ETH had already gone, 140x, right, from what it started the year on. So we were at the tail end. Now we're kind of like still at the beginning, right? ETH is just above its all-time high. BTC is only 2 times its last all-time high, right? There is some froth going on right now, but it's still kind of like, it's definitely, I would say, early to mid kind of stage here. So this to me is just a very, very bullish event for ETH. And institutions who kind of play with these products on CME have been buying ETH anyway through other products like Grayscale, right? So yeah, I don't see this as a bearish event at all, and I look forward to the market kind of showing that, right? We'll see what happens with the ETH price over the coming days. So another big kind of hot topic on Twitter lately has been around, I guess, Ethereum scalability and raising the gas limit to bring more scalability to Ethereum. Now, for those of you who don't know what the gas limit is, I'll give you a quick explanation. I have a Daily Gwei piece about this as well, but basically, the way gas works in Ethereum is that each block has a gas limit, and the gas limit is essentially a block size. So you might remember that Bitcoin has a 1 megabyte block size. It's a bit more than that with SegWit, but 1 megabyte hard kind of block size. Where Ethereum's block size is variable, and it depends on kind of the gas kind of limit here. So the gas limit is, I don't know what it is right now. I think it's like 15 million or something, or maybe almost 15 million. And the higher this gas limit is, the more transactions can fit in a block, or I guess like the more gas that can be used per Ethereum block, right? And you'll know that each transaction on Ethereum costs a certain amount of gas. An ETH transfer costs 21,000 gas. Token transfers more than that. Smart contract interactions within DeFi are a lot more than that, right? So if you have, a higher gas limit, you can obviously fit more kind of transactions into each block, right? So the miners on the network have the ability to vote up this gas limit, essentially. So they can actually kind of, any miner can do this and basically say, okay, I want to signal that the gas limit should be high, should be this high. And then if enough of them do this, the gas limit basically raises to that. They've done this a couple of times in the past, but raising the gas limit comes with trade-offs. And I'll go through them quickly, but this is a great thread from Marius that you should read. It's quite long here and it's quite technical, but I'm not going to read through it all. But I'll give you like the TLDR here. So the reason why we can't just raise the gas limit like 10 times from here is twofold. So as Marius mentions here, there's the concept of an uncle rate. Now, what the uncle rate is that there's when miners are producing blocks, sometimes they will produce what's called an uncle block or a stale block, where it won't get included in the main chain, but because the miners still did the work to produce that block, they will get paid a small reward for it, right? Now, you don't want the uncle rate too high. You ideally want it as low as possible. Now, raising the gas limit means that the miners have to process more transactions, right? The burden of the network becomes greater for them, which means that they are more likely to produce more stale blocks or more uncle blocks, for example. So we don't want that to happen because uncle blocks are a security issue and I think a denial of service issue as well. So we obviously don't want that to happen, and that's why the gas limit hasn't just been raised, really, really high from here. Secondly, is that the Ethereum kind of blockchain size is dictated a lot by the size of its state. Now, the more you raise the gas limit, the bigger the state becomes. So the state is already quite large, and if you just, say you raise the gas limit by like 10%, then the state growth will increase by 10%, essentially. Now, what that means is that it becomes harder to sync an Ethereum full node. So you don't want that to happen. So these are like the two main concerns with it. You don't want the uncle rate to increase, and you don't want the state size to increase, or at least you don't want to, kind of put an even extra burden on people running Ethereum full nodes with this. So, Marius is a kind of a core developer on the Geth client, and he goes through in this thread about kind of like why we shouldn't do this, right? Why we shouldn't raise the gas limit, why it's dangerous. And, he basically speaks to the points I just went through, but he goes into a lot more detail about it. So I highly recommend reading this thread. But I just thought it was prudent to explain to you guys why this isn't like there've been people calling for this on Twitter, and it isn't something that can just be done. It's not a silver bullet, right? It is not something that is going to just fix all our scaling woes and all that sort of stuff for the reasons I just outlined. And I think Peter has a kind of a tweet here as well saying that he thinks that it shouldn't happen either. And Peter is the team lead at Go Ethereum, so he's if I had to say, Peter is probably like the lead Ethereum 1 core developer. He knows the Go Ethereum code base back to front. He could probably code the whole thing with his eyes closed at this point. He is critical to ETH1, and he knows what he's talking about. If you needed to trust anyone with ETH1 development and protocol development, it'd be Peter here. So I trust what he says always. He's very good at kind of getting his point across here. And he says here that if you want more gas, or you want the gas limit to be raised, then you should bring a technical solution to make the clients 10 times faster. Now, this is, as I was saying before, you raise the gas limit, you increase the burden on miners and node runners, and those miners and node runners obviously running clients, right? And a lot of them are running Go Ethereum. So if you can make the clients more efficient and better and make them faster so they can process this increased gas limit in a better way, then you can get the uncle rates down, or at least stay at the same kind of place, and then you can deal with the state growing faster than it was before. So that's another thing to consider here. But as I said, I've got a Daily Gwei piece that I'll include in the YouTube description called Pump the Gas Limit. It was basically, I guess a few months ago, the gas limit was actually raised, and I went through, exactly what that is and what happens when you do it, and like the technicals behind it. It's one of my better pieces in the Daily Gwei newsletter. I usually write short pieces, but it was actually a long one. So I'll link that for you to go check out, basically. So some updates from Tim Bleiko on EIP-1559 here, which I thought was cool. So, it's funny how this was just like buried in a random kind of thread here. But basically, someone asked for an update on when 1559 would be ready to launch. And Tim went on to say, I think it should be ready to be considered for mainnet in the next few weeks. See this checklist for what's left to do. we want to get the client level open issues done before we present it on the all core devs. So there's a checklist here that I will link in the YouTube description, of course, and you can go check out the implementation kind of readiness for each of these clients and the checklist. I mean, most of this stuff has been checked off, which is really awesome to see. And this is, basically all the work that needs to be done before 1559 can be included. And I think he kind of alludes to, once this kind of happens in the next few weeks, then he'd be comfortable proposing 1559 for inclusion, basically, and that could happen within the next 6 to 9 months. So, as I've speculated before, I kind of said that we might see 1559 in like July or August sort of thing, and that would fall into like this 6 to 9 month window, I think, from today. So that makes a lot of sense. So that's great, right? I mean, Tim, as for those who don't know, he is basically the ETH1 kind of hard fork coordinator or network upgrade coordinator at this point. I think he is, and he's basically top level kind of all core devs Ethereum. And he also is leading the EIP-1559 effort too. So he's very important, and he knows what he's talking about when he's saying these things. So very, very positive news here. And he does remind people that 1559 is not going to fix the high gas prices. It is going to smoothen out transactions and give better fee estimation so people won't be overpaying, but it's not going to materially bring down the cost of transaction fees. And I have said this before on the refuel, but there are so many other benefits to 1559 that I think we can live without the gas fees being lowered by it at this point. So Will Price put out this interesting kind of chart here that shows basically the gas used by different transactions interacting with both kind of Uniswap and Sushiswap. And it's funny, I explained kind of last week on one of the refuels that the reason why, or one of the major reasons why the gas fees are so high, is because of these arbitrage bots. Now, what these arbitrage bots do is that they take arbitrage opportunities between different liquidity pools on Ethereum. So you'll have a liquidity pool on Uniswap, on Sushiswap, on Balancer, on Curve, wherever, right? And these bots will basically, outbid each other in gas wars to kind of like get this arb opportunity to make a profit. Now, these account for most of the transaction fees, as you can see here. And Hayden actually said that it's the leading cause of the insane gas prices. And basically, users are competing with these arbitrage bots for space in a block. So, this is something that is, I don't know if it's something that you can solve. I think it's a very hard problem when you think about it, because we obviously, are going to have arbitrage across these decentralized exchanges no matter what we do. The only solution, I guess, would be to centralize all the liquidity into one pool. But then, you wouldn't have competing kind of ecosystems. It would just be one big swap protocol, which obviously doesn't work either. So I think basically, with this reality, as I've said in the past, most users are going to have to sit on layer 2. Layer 1 is going to be a settlement layer for layer 2s. It's going to be a settlement layer for high value transactions. It's going to be a layer that some users go to sometimes. It's obviously going to remain a layer for arbitrage bots and stuff like that. But it is not, it's going to be too hard to keep it as like a cheap kind of layer for end users to use. And of course, these arbitrage bots will exist on layer 2 as well, but because we have so much scalability at layer 2, it will be, less of a problem as well on there. And probably not, I mean, it might be a slight problem, but I don't imagine it being like a huge problem like it is on layer 1 Ethereum today. So yeah, unfortunately, this is what we have to deal with, but it is usage, right? These arb bots wouldn't have anything to do if there weren't users trading on these kind of exchanges, because there would be no arbitrage opportunities opened up, because the bots would just basically collapse that to zero because they're efficient, whereas humans aren't efficient, right? There'll be lots of humans that go to Uniswap and do a trade, and they don't care about like what the price is on like Sushiswap, for example, right? And then the arb will need to be closed, sort of thing. So yeah, interesting to keep an eye on this, and I'm glad that kind of like Will tweeted this out, because I thought it was very interesting. So Santiago tweeted out this thread from kind of like Parify on behalf of Parify, saying that they're proposing the rollout of liquidity mining incentives into Aave to further drive growth, to drive further growth and to drive the V2 migration. So there's a proposal on the governance forum here that you can see if it loads about liquidity mining incentives, and it's a pretty lengthy kind of post here, so I won't read through it. But basically, what they kind of propose, and they've got like a nice table here, is that the Aave protocol should basically pay if the Aave price is $500, which it is today, I think, the Aave LP rewards daily would be $18.2 million. Over a course of like 100 days here. So yeah, that's not too much, right? Because that's over the course of like 100 days, if I'm reading this chart right. Which I think, is fine. I think I don't think Aave necessarily needs liquidity mining, but I think the incentives here are basically to get people to migrate off of V1 to V2 faster, essentially, right? Which I think is a good goal to have, because I think V1 is very expensive to use for starters compared to V2. There's a lot of features missing from that. Maintaining both protocols is very intensive for the team. And, it's also a security hole, because I think V1 would be less secure than V2. I don't know for sure, right? Maybe it's not. But yeah, so this is kind of like, I guess, the main benefit of it. And then the secondary benefit is to further kind of drive growth to Aave, which obviously, we would want to do here. So yeah, great to see this. I'll link this in the YouTube description. You can go read the whole proposal. So as I mentioned on last week's Refuel, Yearn Finance, one of their vaults was unfortunately exploited. There was a few $1 million lost there. So now what Yearn's doing is they're evaluating options to make the vault whole. And the current path that they're on involves making a Maker CDP with YFI tokens as collateral and drawing the deficit against that, and then paying it back with protocol fees. In plain English, they're basically proposing to take on debt on their YFI tokens, right? Borrowing, say, $5 million from Maker, using YFI as collateral, and then paying that $5 million back with protocol fees generated on Yearn. I actually thought this was quite cool, right? I actually thought this was a very innovative way to kind of cover the losses, and then, basically take the losses and basically convert it into protocol fees for Yearn. So it's not like socializing it by printing more kind of YFI tokens to pay it back. It's basically saying, we're going to take on debt, but we know that the Yearn protocol will keep generating fee revenue, and we'll just pay down this debt with the fees generated, which I thought was pretty genius. So yeah, great to see them kind of, I guess, like compensating users, but also going down like a pretty new path here. So there's a tweet here from Crypto Navi, basically describing that there's a proposal on the Sushiswap's forum to leverage Arbitrum, which is like a roll-up technology from Off-Chain Labs, optimistic roll-up technology, as the Sushiswap Layer 2 solution here. So yeah, I mean, this is just another app on Ethereum looking at Layer 2s to kind of adopt here. And I think it's great because obviously there's a race now to get onto Layer 2. And I don't know, if it's great that we're kind of fragmenting things. Maybe Sushiswap should be on Optimism with Uniswap, right? But maybe, because they're competing with each other, they don't mind fragmenting the liquidity here. Who knows, right? But there's also bridges that are being spun up too. So I think the fragmentation of liquidity is not going to be a big deal for very long as well. So yeah, it's good to see another project kind of tackling Layer 2 here. All right, so an interesting tweet from Mike Shinoda from Linkin Park. So for those who don't know who this is, he is the Linkin Park co-founder. And Linkin Park is an extremely popular kind of rock band that's been around for a long time now, and I think kind of like it was interesting that he tweeted this out because he was tweeting about NFTs. So he did like a thread on NFTs and kind of like why he's finding them exciting and valuable. And why I thought it was interesting was because this person is not like into Ethereum and DeFi, right? Like as far as I know. And I've spoken about how Ethereum has a million different doors that you can enter its ecosystem in, and Mike is basically taking the door of NFTs. And I think a lot of people are taking the door of NFTs. And I think that NFTs have mainstream appeal faster than something like DeFi does, because NFT covers like a broad spectrum of things that people are already used to, like art, right? Like collectibles, like in-game items. And NFTs aren't just those things. There are also other more technical stuff, but most people aren't interested in that. They're interested in those three things: art, collectibles, and in-game items. So when you tap into that massive kind of existing user base that's already there, right? You get like kind of these famous people, flooding in essentially, because, a lot of the, I guess, DeFi stuff to the outside looks scammy, if I'm being honest, right? A lot of it, some of it is scammy to be fair, but a lot of it is kind of like confusing too, because most people in the traditional kind of financial system, they defer to their kind of like banks, right? Or their kind of brokers to do this stuff for them, right? To do all the stuff we do in DeFi for them. No one's doing active kind of trading outside of like traders in the real world. Like, it's not like people are their own bank or anything like that. Most people aren't. So, I think DeFi is going to take a bit longer to resonate with people, but NFTs are immediately resonating with people, especially the art scene. So yeah, I thought this was an interesting tweet from Mike here. And he's not the only celebrity that has been doing this. There's been tons of them coming into the NFT space. And I think a lot of them are coming in as well because they can monetize their work now. There's this whole thing of like these centralized companies taking people's kind of work, monetizing it, and then leaving them with scraps. So why not just bypass them and kind of monetize it using an NFT or some other kind of digital rights system on Ethereum, which I thought was, I think is a really cool and appealing thing for these people to kind of, get on board with. So this is one of my favorite recent accounts that I followed on Twitter called Documenting Ethereum. You can go give this a follow. It'll be in the YouTube description. But basically before they tweeted out a chart showing that ETH balances in exchanges are at a 16-month low. So the amount of ETH in centralized exchanges hasn't been this low since since September 2019, which is, yeah, as you said, 16-month low. So, I mean, you can see the kind of like collapse in ETH on exchanges here and how the price basically is tracking this like pretty closely here on the chart. So, how much ETH is here? I think there's like 15.5 million or less than 15.5 million ETH in centralized exchanges right now, down from, 19 million here. So about like 4 million ETH has been taken out of exchanges over the last, I guess you could say 7 months, which is quite a lot of ETH, right? And this ETH is either going into smart contracts or it's going into cold storage, which I thought was really cool. But yeah, go give this account a follow. It's definitely very valuable and they post a lot of interesting stuff. So DCInvestor posted this tweet just before, and I wrote about this in today's Daily Gwei newsletter, but I'll read out the tweet for you. He basically says, and I quote, "If one more person tells me governance tokens can't accrue value, I'll lose it. If you don't get it by now, you're not going to make it. Also, don't ask what I think about XYZ chain. If it doesn't have users or liquidity, it's irrelevant for all intents and purposes right now," end quote. So I think DC was like me at the start of this video. He's going on a little bit of a rant here. I won't address the second part of his tweet. I just want to focus on the first part about people saying governance tokens can't accrue value. This to me is just like so silly because what do you think governance tokens do? They govern the platform. Okay, so if they govern the platform, don't you think that that gives them the right to vote in a value accrual mechanisms for the token? Right? I mean, it does. So this is what I don't get when people say, oh, it's a governance token, it's worthless, why would you buy it? I mean, you buy it now, right, when it's cheap, so that later on, when the protocol keeps growing, the project keeps growing, and then eventually you get to like a point where the kind of like community agrees and the token holders agree that, okay, well now it's time to turn on cash flows for token holders because the protocol is self-sustaining, it's generating a lot of fees, let's pay this out to our token holders, right? What do you think is going to happen to the token price at that point? It's already going to be really high at that point, right? You have a chance to buy it cheaper when everyone's kind of calling it, dead or whatever, or calling it valueless. But, and it's not just the value accrual that you can vote in. The governance tokens can literally vote on anything in a lot of these systems. So, and that's power, right? Governance is power. So I'm the same as DC here. I get like very frustrated when people kind of say this. I'm just like, you're missing the alpha right here. It's staring you in the face. Governance tokens are only called valueless by, kind of the teams for regulatory reasons, right? It is not a valueless token. It has a lot of value and will accrue more value into the future as long as the project's successful. I mean, as a clear example here, like the clearest example I can think of, the Uniswap token, Uni, has a fully diluted market cap of $20 billion. It currently has no fees going to the token. There is no fee generation to the token. All protocol fees currently go to liquidity providers. But the Uni token holders and a lot of people buying Uni are betting on fees being switched on at some point in the future. And they don't care when. They just know that there are plans and there was kind of like plans to turn it on in the future and it should happen, right? So they're betting on that. So from that perspective, you have a DeFi protocol that I think is the most valuable on a fully diluted value basis that doesn't have any cash flows at all. So, I hope to not see people saying governance tokens can't accrue value for very much longer because it just doesn't make much sense to me, basically. Okay, so on that note, I tweeted out something today that was pretty bullish, and I'll read it. I said, I believe that the best DeFi protocols on Ethereum are going to be worth trillions of dollars someday. don't let short-term market movements blind you to this reality. It's a long-term game and we're still extremely early. Now, obviously, over the weekend, we had a bit of a cool-off in the markets, right? ETH dipped to about $1,500. DeFi tokens dipped a bit more across the board, which was natural after we had such a big run-up, I think, recently. But, you know, I saw some panic kind of on Twitter, you know, in some chat groups that I kind of frequent. And I was like, this is weird. You know, if you zoom out to like a week ago, the prices are the same as what they were a week ago. So why are people panicking right now? And I think it's because there's a lot of short-termism in this space where we're spoiled by how fast things can move that people often forget to kind of zoom out. So, you know, I often like put out tweets about like zooming out, and I put out one the other day saying that ETH was $400 in November 2020. Yeah, $400 in November 2020. It's over $1,600 today, 4 times in 3 months, right? So, and $400 seems very far away from $1,600 as well. So, and that's on the ETH, right? Not to count all these other DeFi tokens. You know, at the bottom of the DeFi summer bear, I think Aave was $26. It's almost $500 today. You know, I can keep going on and listing through all these examples, but I won't. I think my main point here is that because we're rebuilding the financial system, because a new financial system has a total addressable market of the entire world, because we have protocols that are already generating a lot of cash flows for token holders, right? I think these tokens, at least some of them, are going to be worth trillions of dollars someday. And I'm not going to say which are because I don't know for sure, right? I have my bets like everyone else, but no one knows for sure. But if these protocols, or when, I mean, I shouldn't say if, I should say when these protocols take over the traditional finance system, a lot of them will basically be worth trillions of dollars, right? I mean, if you look at some of the top companies in the world today, like Apple and Google and Microsoft and things like that, they're worth high hundreds of billions of dollars or in the trillions of dollars in terms of market cap. And, you know, even just comparing it to like banks and things like that, banks are in the hundreds of billions of dollars of market cap, and banks are actually siloed, right? They're not global. They're siloed within, you know, usually within their own country sort of thing. So yeah, I think just zooming out a bit here, and as I said, I think this space suffers from short-termism. I think zooming out even like a few months is going to give you an amazing picture. And when you're investing in this space, you should always invest in something with like a kind of, I guess, like multi-year time frame. You should never buy something as an investment, right? You can buy it as a trade and kind of like say, I'm going to hold it for a week and then sell it. But you should never kind of invest in something and say, okay, I'm going to hold this for a week and then sell it, right? And unless you're a trader. If you're a fundamentals-based investor, then you're investing in stuff when you think it's like a good time to get in, and you're thinking to yourself, I'm going to hold this for years. I don't care how much it, you know, dips during that time. I believe in this project. I think it's going to go far. I think they have like a kick-ass team, all that sort of stuff, right? And I think it's going to bring us to the promised land, right, essentially. And if you did this with a lot of the top DeFi tokens a year ago, you would be very wealthy right now. Like, if I'm being honest, like even if you only put in like, you know, a small amount of money, you would have made a lot. Just from like the top DeFi protocols today, you know, Aave, Synthetics, you know, Compound, all these sorts of things. I mean, maybe not Compound so much because it launched later, but I guess tokens that have been around for a while that were kind of active back then. Even like Sushi, if you invested in that towards the end of last year, it was like 60 cents. It's $14 now, right? So invest in things with more of a multi-month, multi-year time frame rather than like a short time frame. And that's not investment advice. That's just like, I think should be common sense among, you know, people who are investing in this space, is that short-termism leads to pain because, you know, you might see like a massive dip happen and be like, oh, wow, that's dipped a lot. Now what's going to happen? Like, is it going to keep crashing? And, you know, if you sell because of that, it means you didn't really invest based on fundamentals. You invested based on pure speculative reasons. So that's, to me, a losing strategy, I think. All right, finally here. So I spoke last week about how layer 2 decentralized exchange volume is going to catch up to layer 1 volume, and I think it's going to happen quite quickly. And last week I mentioned that Loopring was doing $10 million of 24-hour volume. Well, as of today, it's already doing $25 million of 24-hour volume. Yep, that's over 2x growth in a week already. And that's because they added more pairs to the exchange. They have a liquidity mining program going. A lot of people that are getting priced out by the gas fees are moving to layer 2s on Ethereum. So yeah, I think that was just like really great validation of what I was talking about last week, about how layer 2 exchanges are going to grow much faster than people think they will. and we'll get to a point where they like, basically as kind of big as their layer 1 counterparts, and we'll have like a very nice and bustling ecosystem between layer 1 and layer 2, where kind of the people who kind of, I guess most people who can't afford the high gas fees on layer 1 still get the kind of benefits and experience of DeFi at layer 2. So yeah, just wanted to point that out. But I know I've gone way over time here. I think this is the longest refuel I've ever done. So yeah, I'm gonna stop that there for now. So yeah, thank you everyone for watching and listening. I really appreciate it. If you haven't subscribed to the channel yet, be sure to do so. Give that video a thumbs up, join the Daily Gwei Discord, and subscribe to the Daily Gwei newsletter, and I'll catch you all tomorrow. Thanks everyone.